Good morning, everyone. Just want to let everybody know that this is being recorded. I'm Betsy Hale. I'm the CEO of Cheyenne Leads. And I want to thank everyone for participating. And everyone, just want to let everybody know that this is being recorded. I'm Betsy Hale. I'm the CEO of Cheyenne Leads. And I want to thank everyone for participating and hope that once we have this recorded and posted, you'll be able to share it with all of your colleagues. Jared Walczyk is the Vice President of the state for state projects with the Tax Foundation located in Washington, D.C. He has probably spent at least a good year taking a look at Wyoming and working with the Taxpayers Association and also Cheyenne Leads to really understand our tax competitiveness as it relates to economic development. Some of you on the call might be saying, or on the webinar might be saying, you know, why is this important to economic development? Well, it's really important for the state to understand how our tax policy and how we tax business and industry, how it compares to 49 other states. And it also is relevant in that a lot of those states that we compete with offer a lot of incentives, which we do not offer in the state of Wyoming. So please hold your questions till the end of Jared's presentation. You can put them up in the chat and we'll make sure that he sees those. And we will also have his report on Wyoming's tax competitiveness posted on our website, and the link is also in the chat. There is also a much larger report with an appendix that includes the incentives list for all 50 states in the United States that's available on the Tax Foundation's website. So with that, I'll turn it over to Jared, and thank you so much for joining us.
Well, thank you, Betsy, and thanks for everyone who's on the call. Appreciate the opportunity to speak with you today, not from my offices in DC as I usually would, but from a motel room in Salt Lake City. So getting a little closer to you, but not quite in Cheyenne. I'm going to share my screen. Well, if we can get screen sharing enabled so that I can put some slides up. I'd like to show a few things if possible while we're having this conversation, but while we're waiting to get screen share enabled, I'll just talk through a little about what we're going to be discussing. Last year, my organization, the Tax Foundation, put together a study called Location Matters. It's actually the third time we've done this. And this is a study that looks at business taxation in all 50 states. We do this through a multiple firm study. We take 8 model firms, so the sort of firms that tend to show up in economic development efforts that states try to attract. And we, in concert with KPMG, we put them in all 50 states and we run basically their tax bill so that we can see what the effective tax rates are for each business. We can also see how you have neutralities or non-neutralities either within a state or across states. I think I do have screen sharing, so let me go ahead and get that going here. All right, so hopefully there, just a moment, we will have what we need. So, all right, can someone verify that you do have screen sharing now, that you see something? Sorry about that.
We do, Jared, thank you.
Okay, great, thank you. All right, so with that, I just want to go through some of what we see in Wyoming, because of course that you are a low tax state in many ways. So the first question becomes why are we even having this conversation? Here is a look at state and local tax burdens. This is a study we do, and you can see that you have the second lowest tax burdens in the country, 7.5% effective tax rate, basically on all of the income in the state, individual income, business income, any sort of income. This is how much tax burden is for Wyoming residents paid in state and out of state. And you have, among the lowest in the country, only Alaska is lower. So, why are we having this conversation? Partly it's because there's some disparate burdens. And I think that's a lot of what we want to discuss here today, that burdens are low for individuals and for businesses, but they're falling disproportionately on businesses. And that's something that we need to understand when we're thinking about the competitiveness of different business types. And also when there are discussions about what the taxation of the future looks like. Obviously, Wyoming is one of those states that has been able to rely very heavily on the various natural resources, oil, coal, gas, and these are very important to the state's economy, but you also have experienced what the fluctuations look like in that, what it looks like when there's a downturn in energy markets. Right now, obviously, we've seen this recovery. Yes, you have seen significant revenue growth. You've seen other states like this. I mean, Alaska went from having next to nothing in their coffers about 2 years ago to doing really well right now. But there's always this understanding that even though these will continue to be significant sources of revenue for Wyoming for the foreseeable future, there's always this discussion that if these markets are declining in some way, if there is a need to diversify, what does that look like? What does it look like for the state's tax code and for the state's tax liabilities? And therefore, it's important for us to think about what it looks like now. Here is our location matters study. Like Betsy said, we have the entire study. It's like a 150-page book available on our website, taxfoundation.org, so you can see every state. You can also see all of the incentives, all of the things that go into this. What we're basically doing is we're taking 8 model firms and we're putting them in each state as both a mature firm that is likely not receiving many, if any, incentives, and as a new firm that receives many of those economic development incentives in most states, not typically in Wyoming. And again, we're running their taxes and we're looking at the effective rates. We're decomposing that to see which taxes they're paying and how they're being hit and which elements of the state's tax structure are affecting that. And then we have rankings like this, and you can see Wyoming is the best. So this is great. Wyoming has very low tax rates for businesses, simply because Wyoming has very low tax rates for everyone. You are able to significantly export a significant amount of your tax burden. In fact, when we think about those tax burdens you saw a minute ago, you have 98% of state tax per capita of the national average. You're basically the national average on state tax collections per capita, but only 68% of state tax burdens per capita. Now, where did the rest of that go? It was exported to, well, me and to everyone else who is, buying oil that was produced in Wyoming, or otherwise taking advantage of that natural resource economy out of state. So whether it's falling on the investors, whether it's falling on the consumers, a lot of that is falling out of state. And we see this reflected, and obviously the fact that Wyoming doesn't have either individual or corporate income taxes is good for these businesses, but there are a lot of other taxes that businesses are paying in Wyoming, and I want to walk through a little of that. Here is an overview of the firms that we have in this study. You can see that we do a corporate headquarters, a research and development firm, technology center, data center, shared services center, distribution center, and then both capital and labor-intensive manufacturing. Some of these obviously are going to be more attractive in some states than others. Wyoming has not really moved on the corporate headquarters front, but some of these others are very important. And you can see how these different industries rank. You can see that the effective rates are pretty low across the board, but they vary a lot. That different industries, because of non-neutralities in the tax code, face very different effective rates. In a perfectly neutral system, you wouldn't have everyone paying exactly the same amount, the same effective rate, because they have different exposures to the tax code. There's no way to solve that problem. Some businesses are going to be heavy on property. So if you have any sort of property tax, they're going to have more of their net income being subject to some sort of effective rate because of that property taxation. There's lots of different ways you can have different exposure to the tax code. But when you see these variations, when you see that, for instance, a new distribution center has an effective rate of about 21%, but a mature data center has an effective rate of 1.9%, you're seeing something's happening here. There's some sort of difference in the way that we are taxing these industries, or the way that our tax code is designed, that favors some industries and some activities over others. Data center is one of the few areas where you do have some level of incentive, where you have made it very attractive for these firms to locate there, just based on different elements of your tax code. But you can see these low rates across the board, but lots of differences. And you can also see that if you're looking at rankings, the shared service center is doing great. When you look at the rates, you think, wow, not so much. So you can see those disparities exist in lots of states, not just in Wyoming. This, though, is what the crux of what I want to talk about. Here you can see the personal and business shares of Wyoming taxes. This is a table we put together based on a variety of data sources in Wyoming. And you can see for fiscal year 2021 how the taxes break down. And you can see that 69.5% of all taxes in Wyoming are imposed on businesses. Now, a word on what that means, because you may be stopping and saying, well, wait a minute, what does it mean for business to pay tax? Ultimately, isn't the economic incidence on individuals? And yeah, I mean, that's actually correct. Businesses are legal entities. They're fiction in a way. Fictions do not pay taxes. People do. But whether the tax falls on businesses or individuals makes a lot of difference for investment decisions. It matters for who it's falling on. Most states have significant sales tax revenue from individuals. You will get into a moment, obviously have sales tax revenue from individuals, but a lot of this is business. They tend to have individual income taxes, which you obviously do not. They tend to have another variety of other personal taxes that significantly fill up that first column that you do not have. At the same time, you have a lot of business taxes, at least in terms of your composition of your taxes. Some of these are because of your unique industry mix. You raise a lot of money from severance taxes and other mineral-related taxes. That really, no matter what you do with your tax code, that's going to be the case, and that's going to mean heavier reliance on business taxes than you would see in sort of a typical peer state. Nonetheless, you can see that just across the board, even outside of that category, there's really a lot of focus on business taxes. Note, for instance, the breakdown of sales tax, and note that businesses bear more of the burden of the sales tax than individuals do. And that's a rare split. Sales taxes in every state, unfortunately, tax a wide range of business inputs. They're taxing those intermediate transactions, and this is something that economists say you really shouldn't do, because the sales tax is supposed to be a tax on final consumption. When it taxes intermediate transactions, it results in what's called tax pyramiding, where ultimately the same final good or service has the tax embedded multiple times over. The broader your base is on business inputs, the more that's going to happen. The more that there is, a longer production chain, more exposure to that, to that sales tax, the more a business is going to be hit. Incidentally, pyramiding is more of an issue often for smaller businesses than for larger ones, because large businesses tend to be fairly vertically integrated. They do a lot of things in-house. There aren't as many exposure points. For instance, they're not using contract HR or contract payroll. They might be doing their advertising in-house. They might be doing their packaging in-house, their distribution in-house. All of these different things that could be a point of exposure to sales taxes on that intermediate transaction, either on the business's general activities or on the specific production of a good or service for sale. A larger, more vertically integrated business might have relatively few of those exposure points. A smaller business that doesn't specialize in, say, packaging, whatever they're producing, or distributing it, or has contract legal services. These are the sort of things where you tend to, actually, legal is not in your race, sorry. South Dakota has that, you do not. These are the sort of things that get exposed to business input taxation and then tend to pyramid. This is important for the nature of the sales tax as well. Sales taxes tend to be destination sourced. What this means is that your sales tax rate and even your sales tax base does not, to the extent that it falls on final consumption, hurt Wyoming businesses when they compete in a national marketplace. If you are selling from Wyoming to Colorado, it doesn't matter if your sales tax base is broader than Colorado's, if you have a higher rate than Colorado, it doesn't matter, because the Colorado purchaser is going to pay Colorado sales tax on that transaction. So it's this destination source tax. It has very little economic impact. It doesn't change investment decision-making. It doesn't, it doesn't have all of the impacts of, say, an income tax until you substantially tax business inputs. Because this changes it. It makes it a source-based, instead of it being destination-based, it is origin-based in its nature. If you have a business in Wyoming and you are purchasing things as a part of your business activity that are subject to sales tax, those are now your business costs, and you wouldn't experience those if you were operating in a different state. One of two things is going to happen, or maybe both. Either if your footprint is regional, if the sort of industry you're in is one where the ultimate consumers of your product can't go too far afield, they sort of have to buy locally, or there's significant other advantages, including general price advantages of buying locally, then the sales tax that is being imposed on this business is going to be passed on to the purchaser. It's going to be embedded in that price, and it's going to be embedded multiple times over. If the market is much more national, or at least more broadly regional, and you are competing in state substantially with out-of-state producers, then you're simply going to have a lower profit margin, and you're going to have to work within more constraints because you have more business costs than your peers, than your competitors who are operating in another state and are not exposed to this additional level of taxation. So this is a pretty significant element. In fact, when we think about the size of this, something that I think is very notable, 58% of your sales tax falls on these intermediate transactions. That's $558 million. $568 million that comes from businesses. That works out to $976 for each Wyoming resident. Now, that's more than 28 states generate in corporate income tax revenue. So you talk about your state that doesn't have corporate income tax. You have a sales tax that falls on business inputs to a degree of more than 28 states, corporate income taxes. Even though these are much larger states, typically, states that have significantly more population, significantly more business income, you're still above average there. Now, what if we just said, what about the extra? Because obviously, most states do unfortunately tax some level of business inputs, but like I said, you are abnormally high in this regard. So what if we took the national average and we took that out, and then just looked at your residue, the additional amount compared to an average state that you are imposing on business inputs? That still works out to an additional $162 million. That's $278 per person, more than the ordinary base. If you captured that extra revenue in a corporate income tax, then on a per capita basis, it would be the nation's 8th largest. So again, you don't have corporate income tax, you have something that in many ways is more punitive towards businesses than a corporate income tax. And of course, is falling on C corporations and pass-through businesses alike. I mentioned that as you can see here, 69.5% of Wyoming's taxes come from businesses. It's the second highest in the nation after North Dakota, which is about 71%. The national average is 44.3%. So you are substantially above that. Businesses are paying, what is it here, about 2.37 billion. 2.37 billion in Wyoming taxes. Individuals are paying about 1 billion in Wyoming taxes. If this matched the national average, individuals would be paying about 1.9 billion, and businesses would be paying 1.5 billion. You'd be flipping this. I'm not saying you should do that. And in fact, I think that the competitiveness for individuals is a wonderful thing about Wyoming's tax code. But nonetheless, as you think about what the future holds for Wyoming taxation, it's important to at least remember that businesses are bearing the vast majority of the burden in Wyoming right now. What this means, of course, is that if there is additional levels of taxation in the future, if there are further changes, that there's not necessarily a ton of room to move on the business side, at least proportionally. So obviously, there's been discussion of a corporate income tax over the years, and I think what's notable is that it's really hard to raise a lot of revenue from a corporate income tax in Wyoming. The last proposal, obviously, it had some carve-outs that theoretically you don't need to have, but nonetheless, it would have raised $24 million. You can look at this list here, and you can see that the corporate license tax raises almost $16 million. 2/3 of what you'd get out of corporate income tax is already in that corporate license tax. You look at these other taxes, and again, $568 million on the sales tax, or how much you're getting. I mean, even the miscellaneous energy taxes that fall just on businesses. We're not talking on energy producers, but just energy use. These things are comparable in many ways to what you could raise in a corporate income tax. And Wyoming also has to be cognizant of the fact that There are some costs of doing business that don't exist in other states. Now, some states have high costs of doing business because property is really expensive or because it's just an extremely expensive place to live. That is not Wyoming. The flip side of this, especially if you are a business that might be, working directly with consumers, a retail business, or otherwise, very focused on the region, that low population density really does impact your bottom line. We think, for instance, about, in the context of corporate income tax, supermarket chains typically have profit margins of 1.1 to 2% in a typical state. In Wyoming, that margin is really, really slim. So if you have additional taxes on businesses of any type, you are actually making it potentially, cost prohibitive to have retail in certain parts of the state. It's got to give somewhere. Either you're not going to have it, which I think already, you have significant stretches where, there's just not enough to sustain a large retail presence, or you're going to have reduced hours. You're going to have, pressures on payroll. You're going to have, selection changes. A smaller supply focused more on, a smaller range of goods that have higher markups. All of these things happen. And this is one reason why I think you and South Dakota are the two states without a corporate income tax, because it tends to really be an issue for those low margin businesses. But you already have some big taxes on low margin businesses that you need to be aware of. Again, in context right now, that still leaves you really competitive in many ways, because even though the burden is disproportionately on business and not on individuals, the overall taxes in Wyoming are sufficiently low that even if it's disproportionate, even if it's overwhelmingly on one side of the ledger, the result is still a relatively modest level of taxation for anyone, individual or business alike. And again, some of these are just going to exist regardless. Your minerals ad valorem tax, your severance taxes, these are going to be business taxes that, of course, you are going to have as long as you have this thriving industry that is in the extractive world and is sending these products across the world. You're going to have those taxes. But when you look at the rest of this, when you look at how it splits, business versus personal, that is a balance that doesn't exist in states that have more diversified economies, doesn't exist in states that have higher levels of taxation. It is something that works for you as long as your taxes remain this low. But as there are these discussions, whether they come to fruition or not, of what does the tax code of the future look like in Wyoming, I'm going to tell you that you cannot have a tax code that is more typical in terms of its revenue generating potential and has this split. This would be just incredibly prohibitively expensive for business if you were to do this. So you go back and you look at those burdens and you say, okay, we can handle this. These effective rates are reasonable for the most part, but this is again in the context of one of the lowest tax states in the country. If you started climbing up more towards a median, these effective tax rates on business would become extremely burdensome. So good news for now, caution for the future, where you certainly need to be cognizant of what it means if you are going to increase taxes on business. You don't have a lot of room there, or if you're going to increase taxes overall in a way that would affect both individuals and businesses. Now, it's never easy to say, well, if we're going to make tax changes, let's have them fall on individuals. Let's have them be personal taxes. But it is really important to understand that no typical state has this sort of split. Again, the only other state that looks at all like this is the Dakotas, and North Dakota, substantially because of the energy industries there and just how much of the taxes come from energy. South Dakota is not even quite as high, but nonetheless a state that sort of looks like that in terms of having a similar tax code to you. So again, I think some good news here overall. You look at these rankings, you look at the effective rates you have, and certainly you have designed a tax code that in many ways is very favorable to at least to a lot of the businesses you have. You're doing some things right. For instance, you don't tax inventory. That is something that's probably particularly important in Wyoming, where having inventory out of state and bringing it in sort of in a just-in-time way, whether it's for retail or for manufacturing, would be really burdensome. You thankfully are not among the states that tax inventory. You don't do a significant amount of gross receipts taxation. You have a tiny little gross receipts type tax, tiny capital stock tax. You have, again, the lack of an income tax means that individuals and businesses are getting a break there. A lot to be said here for a very competitive tax environment, but it's competitive because it extracts relatively little. It's not competitive because it is extremely well structured. There are other states that generate a lot more, but do so in a way that is fairly neutral in its application. And basically, my takeaway for you right now is you look really good on a lot of the tax rankings because you don't raise much. You don't look as good due to structure or due to distribution of burdens. If you were to scale up how much you raised, you would lose a lot of the competitive advantage that you have right now. And I think, again, just looking at this, think about where these taxes come from, think about the volatility associated with them. And, as you think about the tax system of the future, where do you go from here? Where do you put those taxes? Or what do you do to avoid the need to raise these taxes in the future? Obviously, Wyoming right now is sitting on a significant amount of revenue, both some general surpluses, also the ARPA funding, which obviously has some limits in its use. But how do you build that buffer so that you don't have to make significant tax increases in the future, but also how do you think about the tax code to make sure that you are not making the state unattractive for business in the future? And with that, I think I'd be happy to take any questions that anyone has. Oh, and I see a question just in here about, could I give an example of intermediate sales taxes business incur in Wyoming from Ashley Archery? So lots of them, to be honest, and in every state you're going to see some of this. But for instance, if you are producing tangible goods, let's say you're a smaller manufacturer, you just produce them, you really don't do the rest of it. You're not going to pay sales tax on your raw materials. That's generally exempted. You are going to pay sales tax on some of your energy consumption in a way that consumers would not. You are going to pay sales tax if you use contract HR, if you use contract payroll. You're going to use sales tax if you have someone else doing packaging, distribution, advertising. I don't believe the actual advertising is taxed in Wyoming when you place the ad, but the company that provides the advertising service that maybe designs the ad, you're going to pay sales tax on that. If you have janitorial services, you're going to pay on that. If you in addition to like using a separate distribution service, if you are renting equipment, you're going to be paying on that. All of these things are subject to sales tax, even though they're business inputs. They're purchases clearly by businesses. In many states, they'd be significantly less taxed than they are in Wyoming. Again, no one has completely exempted them from the sales tax base, but point of comparison, 58% of your sales tax revenue is coming from business inputs. Utah, where I am right now, is 26%. So it's not zero, no one's zero, but you'd much rather be 26% than 56% or 58%. So hopefully that answers that question. And happy to take additional ones. I think I had seen a hand raised or.
Don't text. Jared, do you see Dan Noble's?
Yeah, I do, and I thought you taxed at least the like ad design. You don't tax like actual advertising. I thought you taxed some of that, and I apologize if that's mistaken. I have to go look at there's a matrix that shows and like advertising is broken down 4 ways, and I think you check at least one of the boxes, but not all of them. Happy to take additional questions though. Do I have an estimate of the sales tax burden paid by the extractive industries? Unfortunately, I do not. I can see if that is available. It is not the most significant portion of their tax burden. Obviously, they are paying much more in terms of the ad valorem and the mineral and the severance taxes, but nonetheless, a decent number of their activities are subject to the sales tax as well. I think what's notable here, though, is that when you look at that additional $160 million compared to an average state, a lot of that is coming from businesses that aren't in the extractive industry. It is really the sales tax is probably in many respects your primary business tax, the one that is hitting sort of ordinary businesses as a part of their day-to-day. So yes, the extractive industries are subject to that because they are just a big generator of activity. Generally, it's a meaningful portion of it. Unfortunately, I don't have a full estimate, but the nature of what is in and out of the sales tax base is such that a lot of that is being borne outside of those industries. It's not primarily a tax just on them. Certainly, disproportionately, you are taxing those industries, but you're hitting them especially hard with the taxes that are sort of geared towards and designed around those industries. And a lot of that gets exported, and a lot of that will happen anyway. I mean, you're going to have oil, you're going to have coal, sort of regardless of the taxes. I mean, there's limits, obviously, especially as prices fluctuate and different fields become more and less viable. But having severance taxes, having mineral ad valorem tax doesn't impede having this activity in the state. Having sales taxes that fall substantially on certain general business activity does make it far less attractive to do other things in the state, to have manufacturing in the state, to have some other general businesses in the state.
And it looks like Dan talked a little bit more there. If everyone
and I agree with that. I mean, that's what I was saying. Like the generally speaking, that's so he says that inputs paid by the mineral industry are taxed during the production of the mineral exploration is typically exempt, and I mean that is accurate. Obviously, the improvements to tangible property is significant for that industry and significant for lots of other industries.
So I think the largest sources of revenue, Dan, if you can correct me, would be basically the utility bills, the power, and the office supplies, any inputs that they have that are not necessarily outside of the office administrative.
Well, you can jump in, but the again, a lot of tangible property purchased by business, including repairs and improvements, as he notes, are subject to sales tax. So, again, that's a significant burden for manufacturing businesses as well.
Any additional questions out there? I know this is pretty heady stuff, and we all can continue the conversation. Our goal as Cheyenne Leads was really to have the research conducted, have an opportunity to look at not only what Tax Foundation is seeing, but also KPMG and the work that they do with business and industry through audit and taxation, and really not provide an opinion one way or another, but at least provide information where we can start a dialogue on how we continue to diversify Wyoming's economy. So if there are any more questions, we'll give everybody some time in their busy day back. Jared, we want to thank you so much, and hopefully we'll continue to see more conversation around this topic, working in partnership with all of our other economic development entities.